Yo, what's good, guys? Welcome to the Traders Reality Show. My name is Tino, and today we're going to be talking about vector candles. Now, most of you in the channel have been asking about these vector candles. What's the difference between the two? What do the colors mean? So this video is going to help you understand what they are and how you can use them to exploit price action in cryptocurrency. First things first, guys, if you are new to trading altogether, what is a candlestick? Now, you can go and Google what a candlestick, but when you find out what a candlestick is, okay, the conception is kind of flawed, all right? What we understand a candlestick to be normally is different to the way we see it in the streams, all right? Let me bring this to you. You can see bright as day on the Euro USD chart right here that a normal candlestick itself, you can see that a big green candlestick implies that there's bullish activity, all right? So pushing price higher, all right? You can see 1, 2, 3 pushes to the upside. That's inducing traders to believe that there is now a direction of bullish activity to move price higher. You can see that they act like big bearish engulfing candles where it takes over the previous candle right there and another engulfing candle right there. It takes over the previous candle that was below it, all right? Why does it turn back? Well, is it because there's a supply? And I'm even going to go into the story behind what supply and demand is in charts. You have to understand that this marketplace is managed, right? It's a business model for liquidity providers to move money from one place to the next. And you have to be really mindful of that because that's going to help you understand what the vector candles are. So conventional wisdom says big green candle, bullish, big red candle, bearish. So they understand it as buyers, sellers. But then when we look at the vector candle itself, we see a different story. Buyers? Nah. The only buyers that are behind this candlestick are the buyers who are being sold to. You can only buy if someone sells. So who's in control? The seller. Because the seller will only allow the person to buy to a certain level before he wants to get the profit from his shorts that he's been selling to the buyer. You can only go long if someone else goes short. And if you can only go short, that means you can only go long after. Do you understand? Shorts are built when price is rising, but they are opened when price is dropping, because that's what the retail trader does. Retail trader goes short when price is dropping. Market maker goes short when price is rising because you only go short at the highest point. Yeah? If you're going to buy a product or buy something to sell, what are you planning on doing? You're planning on selling it at a higher price. Likewise, if you're going to go short, you want to go short from the highest price. You don't go short from the lowest price because you're coming into the market with the false belief that because it's going short and price is dropping, it means it's going to continue to drop. No, you want to get in before the drop happens. And the way you get in before the drop happens is by focusing on vector candles. You see, we understand these big green vector candles as the market maker marking up his shorts by inducing retail traders to believe that price is rising. You can only buy if someone sells. So the market maker has trapped the retail trader here, he's trapped him here, and he's trapped him here. And one final attempt right here, which sets up the range to bring price back down. And then the retail trader buys the dip, and he's convinced to buy the dip with this big push to the upside. And then guess what? Market maker attacks the range to the downside. Why is it that they always seem to turn at key points in the chart? Now, the vector candles themselves are based on the tick of the transaction of volume inside this price action here. So it's how often price changes in this range. Now, down below right here, you can see the PVSRA volume indicator. So that would imply that a lot of shorts were opened by the market maker, but the retail trader sees that as buys, okay? Then as price moves higher and higher, you can see the market maker's intention. He marks up the shorts at the highest point, and then he releases. The same with the red vector candle. It means that there are a lot of longs being built in this range because prices exchanged hands quite frequently. So if you look at the bottom here, you can see there's a number of 31,000 over here, 31,927 tick changes in this zone. That's how many times it changed hands, all right? The way you use these vector candles is a graphical representation of where you are with the market maker. He goes long when price is dropping. He doesn't buy at the highest price, he buys at the lowest price. Are you going to go to a car dealer and say, I want to pay for a car that is the most expensive and increasing in price? No. You buy at the lowest point possible. Isn't that what everyone does? I mean, how many of you are going to actually buy a car and just say to the guy, please, I want to pay the highest price possible? Well, he's going to look at you and be like, thank you very much. I ain't going to say anything to him. This guy must be stupid. But the principle is there. Retail traders buy when price is rising and they sell when price is dropping. Doesn't make sense. I'll say it to you. Are you going to buy something to sell at a lower price? No, you wouldn't. And I know there's going to be guys that are going to say, yeah, but if you actually get it really, really, really cheap, okay, and, you know, you can actually take a little bit off it and, you know, it doesn't make sense, does it? You can't make a profit of selling something that you brought cheap and sell it back to yourself cheaper kind of thing. It doesn't make sense. So why does it make sense, okay, in the trading world? How does it make sense for you to buy when price is rising and you sell when price is dropping? Doesn't make sense. When I say sell, you sell to go short. When I'm talking about buying, you're talking about going long. The blue vector candle itself is another example of the green vector, but it's different. See, the green vector implies that volume is above average. So the exchange of volume at that point in time is above average. Okay, it's at its highest point. This blue vector means that volume is starting to increase. But at the same time, when it's starting to increase at the highs, does it mean it's actually slowing down? Because for every blue vector candle you see in the charts, price pulls back. Let's go find ourselves some blue vector candles. Blue vector pulls back. Blue vector followed with a red vector pulls back. Green vector at the highest point. Inside there'll be more vectors. Blue vector present. Stop hunt rise by the market maker traps the retail traders to the commitment of longs, and then they pull it sharply back. Likewise, the only time that the blue vector does act as a valid move to the upside is if it appears at the lowest point in the chart. You can see red candle, blue candle formation. The blue vector appears here. Price comes up away from it. Same with the green vector. Price comes away from it. Now, some of you are probably saying, yeah, but hold on, Tino. Principally, we should be going long when we see a green vector candle. That is correct, because it's on the basis that you are going to catch the markup phase by the market maker whilst he's trying to trap the retail trader. So if we actually take this right here, all right, and cut it off at this point, we would say to ourselves, okay, then cool, I see a green vector candle. Should I enter in? Price is rejected away from the 50 EMA. It looks like they favor higher prices. So you know that the market maker is preparing to make a move to the upside. And what is it that you prepare for? You're preparing for 3 hits to the high. So there's your first hit, all right? Come up again, bang, market maker. 3rd hit, bang, market maker. 4th hit, okay? The hits to the high, 1, 2, 3. Or you can count that as the 3rd one as it's bigger. What I'm saying to you is you see one vector candle, you know the market maker's starting to offload his shorts. He's getting ready to add shorts by inducing the retail trader to go long. So that's when you actively get involved into a candlestick like this, because you're riding the market maker's trap. You are taking advantage of the retail trader coming in at these points to add liquidity for you, so that when you come to the highest point in the chart or a zone where you think it's getting ready to drop off, that's when you close it. You don't close when it's pulling all the way back here. You don't close when it pulls back to the 50. No, you close into the momentum of a vector candle so you can lock in the most amount of profit from that move. Okay? Likewise, the violet candle is no different to the red candlestick. So the red candlestick, that volume is above, you know, it's more than above average. Okay, there's a high volume transaction right here favoring lower prices. So the market maker is favoring longs. So he's building longs at lower prices. So there's pressure. All right. 1, 2, 3 hits. They shift out of the zone. The violet candle implies that volume is starting to rise. So they may be building more longs, but they're also slowing it down because they don't want to release the liquidity to the downside, because in order for them to build the longs, they have to induce the traders to go short. Now, if they allow the retail trader to go short and they keep price in this range, the retail trader is going to come with an influx of orders to go short because they think it's going to break down. And then the market maker will be obliged to fulfill that obligation. And then the market maker's attempt at building longs from this point to this point would have to be extended. And then he would have to allow price to drop lower. But if he does drop it lower, the retail trader is going to realize profit in this area here. So he's going to close his trades. Then the market maker won't have the liquidity to actually mark up his longs because he hasn't got enough traders trapped. In this area, he's got them trapped. If he lets price go lower, he won't have that many traders trapped. So then he will have to keep on bringing price down lower and lower and lower. And the market maker is not about being in the red, and he's not about charity, which is why we see these vector candles shifting out of the range when we see a certain pattern. So you're asking yourself, how can I use them in cryptocurrency, Tino? Pretty simple. Come to the streams. We talk about them all the time. But more importantly, having an understanding of the market maker's cyclical behavior is going to help you understand at what point is a vector candle valid. You see, when you see vector candles appearing at the highs, you do not want to be getting involved in those ranges. Why? Because that's where the retail trader is getting trapped. Look, the deviation away from the 50 EMA, they've moved price away from the 50 and they brought it straight back. Are you the guy that's going long in this area here? Don't be that guy to go long. Let the retail trader go long. You should be going short in that area. I hope that actually serves purpose. I hope that brings you into a little bit of an understanding of what the vector candles are. The streams talk about them every single day. All right, so you'll understand it more and more as we come to the streams, because the streams talk about it in real time and as the candlesticks themselves develop. Okay, if you want to get access to these indicators, I say it many times in the streams, head over to the website tradersreality.com. It is in the description of this video. Head over there and you can download the indicators, and there are also other videos that talk about how to understand the vector candles as well. All right, mad love and respect to every single one of you. Take care of yourselves. Peace.